Welcome to Chit Chat Stocks. This is another episode of our weekly Power Hour where I am joined by my co host, Brett Schaefer. I am one of the hosts as well, Ryan Henderson, and it is earnings season. So we got plenty of material to talk about. I've got my small cap of the week. I also have maybe a new segment here, Moatwatch. Maybe. I don't know what you think about that, Brett, but I've got a potential emerging moat showing up here. So we're going to talk about that as well. Brett, any topics that you're bringing to the table this week?
I mean, we just got earnings, PayPal earnings, Alphabet earnings. Well, you made the notes for those, but we're both going to be able to discuss them. Tesla earnings from last week, SoFi. What are some non kind of hyper growth companies that we have there? Electronic Arts, Visa, plenty out there. And I don't know if you saw this today, Super Microcomputer. A little bit of a interesting decision from their auditor, but I won't spoil it. We'll get into that later.
Okay, sweet. And before we do, we want to talk about our friends at Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account at public.com. It's a pretty big deal because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments. But you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks. I'll also say, made myself an account yesterday, and the yield is real. It's actually gone up a little bit as well. So potentially opportune time if you're listening to this today and you've thought, I'm saving for a house, I'm saving for something, I want to yield now. Don't want to let it just sit in a boring old savings account, and you're looking for a bond account. Perfect time potentially. So I'll leave it
Yeah,
there.
the yield is real and it's spectacular. No, that's a joke, but the yield is what they say it is, and yeah, go check them out. Full disclosure for it can change on you, but it is higher. It is not a savings account, but it is a bond account. It's a great way to access a different part of the financial landscape. I have a question from Twitter here, Ryan, that I think leads into the entire episode because I'd say this is the meat. This is the number one earnings season week. And full disclosure, we're recording this on October 30th before the market closes. So there's some earnings that we're not going to be able to see yet, but we'll talk about them next week. Here's a question from Stock Spotlight. Would be interesting to see how you look at and react to quarterly earnings reports from the stocks you own. For many investors, especially those beginning out, quarterly earnings reports can cause uneasiness and anxiety. Well, I think we're going to talk about at least 5 or 6 today. And what one do you want to discuss first? Google, perhaps the best quarterly earnings we've ever seen from a company. That might be hyperbole. Nvidia, it's maybe Google's best earnings report ever, or the last.
Yeah, that's true. And the other interesting part is usually they report great results, and then Sundar Pichai comes on and gives like concerning commentary, and all of a sudden the stock just drops back down. That was not the case this time. And I do want to, before we get into some of the earnings, I want to actually address the question because it's an interesting one. There's so much volatility around earnings season, especially maybe not every company, but sometimes you get a beat by a penny, missed by a penny, huge reaction, and it's just completely unjustified. And so something that there's no, I don't know if this is actually a good strategy, so don't copy me here. But if you have had, if you invest in businesses that you think have a moat, you're very long-term oriented, and you're buying businesses that you want to own for a really long time and potentially add to over time as well. If you've built up the kind of knowledge of the company, you've known it for a while, maybe you've owned it for a while. Something that I actually do, even if I haven't had time to really internalize the quarter, like maybe I read the report, read commentary from management, maybe listened to the call, maybe you weren't able to get to all of it, whatever it is. If you have a huge adverse reaction, I I have actually been it has worked out to me to nibble a little bit the next day at the open. If you get like Amazon, for example, last quarter, there's always an overreaction, it seems like, when there is a small miss, something like that. So I don't have any problem, I guess, adding to shares on big drops the day after. Um, you do at least want to check the report and make sure there isn't something that materially changes your thesis. But if you're owning these things for a long time, I think it's pretty rare that a single quarter should shake you out, especially if you've owned it for a while.
Yeah, I think that makes sense. You don't want to compete with Renaissance technologies, algo stuff willy nilly and just say, well, if something has a big drop. And what I mean by that is the reason these things drop and they drop literally instantly is because it's a lot of computers ingesting it and then the computers are trading. If you see something that perhaps the computers are reacting to and that matters in the short run and they think is going to cause the stock to drop and it can kind of be a self-fulfilling prophecy, but you still think the business is fine over the long term. Yeah, I mean, if it's an existing holding, it's not a bad time to take a nibble. I like the idea. You just have to make sure you understand the earnings report first and make sure there isn't something you're missing.
Yeah, and it's got to be huge. Like, in my opinion, there has to be something really, really material that came out from the report to like warrant not nibbling at all or selling your stock. It's so easy. And you know what? I did this today or yesterday with DR Horton to see the price reaction and think the market knows, the investors know something. This was horrible, whatever. And the reality is, like you said, a lot of it is just computers reacting to they're literally parsing the document, seeing whether it was beat or miss, and instant reaction, and it gets oversold all the time. So yeah, I do think uh, there's no harm in nibbling if you truly believe in the business. But with that said, do we want to pick a company here to talk through?
Yeah, let's do Google. Go right through the numbers.
Well, I don't have all the numbers in front of me. I guess I handpicked a couple of numbers. I guess some of the highlights, uh, YouTube across both advertising and subscription. And Brett, maybe while I'm talking, you can pull up some of the headline numbers because I probably should have jotted those down. But across advertising and the subscription business, so that includes NFL Sunday Ticket, YouTube TV, YouTube Premium, and then obviously YouTube advertising. They crossed $50 billion in trailing 12-month revenue. For context, I know people do this like every single quarter. They acquired YouTube for I think $1.6 billion in 2006.
That's good.
So
Yeah,
it's
good
been
clickbait.
a
It's always good
nice
clickbait.
acquisition for them. Um, but this actually does give us a little bit of insight into the size of the subscriptions business because it sounds like they're generating roughly $15 billion across them over the last 12 months. No idea on the economics of those because part of it might be Sunday Ticket. We don't know the split. Part of it might be YouTube TV, which I imagine is not extremely profitable given just the economics of, or the uh, suppliers in that business take a lot of the economics. Um, but yeah, I guess kind of a victory lap there for YouTube. The advertising revenue for YouTube specifically, I believe, grew 12% year over year. Search, Google search and other, I think is how they categorize it, grew revenues 12% year over year. So doesn't seem to be an advertising slowdown. And perhaps the biggest bright spot of the quarter was Google Cloud. Revenue at Google Cloud accelerated rapidly. The revenue growth, I should say. It was going, I could check this on FinChat real quick, but it was like mid-teens percentage year over year revenue growth the last couple quarters, I believe. And then they jumped up to 34%, if I'm not mistaken. Sorry for my typing here. 34% revenue growth at Google Cloud, I believe, this quarter. Either way, it was a massive acceleration. And probably the most impressive thing was that operating margins, which we've talked about this on the show before, but operating margins at Google Cloud have just steadily increased for like probably 30 quarters in a row. It's gone from I think like negative 30, maybe negative 40% operating margins to this quarter 17% operating margins. And one of the analysts on the conference call asked about the rapid kind of margin expansion at Google Cloud. And the answer from, I'm not sure if this was the head of cloud or Pichai himself, but he says, like, what's driving this? And he says, the first is scale. Obviously, as we scale the business, we have more opportunity for margin expansion. But the second, and shouldn't be underestimated, is the work the team has done to drive efficiencies across the cloud business. And we're seeing those come through, whether it's through headcount management, which is an interesting term. And you know what? In Google's case, it might not be layoffs. It might literally be just hiring less people. Facilities management, other process efficiencies. We are seeing that go to the bottom line and driving the results you are seeing this quarter. I guess my question to you, we talked about this literally a week ago, and you laid out a thesis for Google and why you'd add to it on a 20% drop. And one of the points, I guess, of contention was the potential margin expansion. Do you think we drastically underestimated the margin potential for Google?
Maybe slightly, but not drastically. I mean, I think I said it would be around where it is today, which is about 30. I don't think cloud's going to get that much higher, but Google Services is at 40%. And the way they do accounting, though, like the Alphabet related activities and other bets, some of that is related to what powers Google Services because there's AI stuff. I'm not sure exactly what all the details are, but the consolidated
It's
profit
also
margin this quarter was 32%. I don't know if it's going to be that much higher with the other bets and AI investments they're putting through, but hey, prove me wrong. Uh, it keeps
yeah,
going higher.
it's worth noting that segment level margins, like all the people you hire in cloud require certain back end costs as well that are probably not grouped into cloud. I would guess might be different here in this case, but
Maybe.
there's probably costs across the organization that apply to cloud that maybe are not categorized there. So could be wrong on that, but yeah. What do you think this business? What kind of profit margins do you think Google Cloud, and maybe AWS, Azure, all three of the hyperscalers together could have kind of at maturity?
Seems like 30%. I don't know. But it's really
You think
hard to tell
AWS is
because
showing kind of the mature margins already?
maybe. It's just hard. It's hard to tell because it it all depends on if they want to start a price war with each other. But what's interesting is Google could be, and I'm not saying they have it yet, but they could be forming a competitive advantage if they say, what they say about the efficiency costs on their computing is true, because then they could charge the same price as someone else and earn a better margin. But r- you have to ask the heads of those companies if they want to start a pricing war. And if they don't, I think margins will be high. But if they do, well, then, hey, margins can go really, really low.
Yeah. I
And is AI
wonder.
a bubble? I don't, is the AI spending a bubble? Maybe. If AI spending is a bubble, then there's going to be a lot of excess computing capacity that doesn't get used. But if it's not a bubble, it's going to be, the margins are going to be higher because it's all about the capacity utilization.
I wonder if, and sorry, it seems like my internet might be struggling here, so I apologize if it's not looking good. But I wonder if there's like it's really a commodity. Like we look at the cloud services and it's easy to think, oh, okay, it's probably AWS offers similar stuff to GCP, but I imagine it's probably more nuanced. And there's certain services that Google Cloud maybe offers that AWS does not. Maybe it's a better fit with certain companies as well. Same for like Azure. So I wonder if it could just, I think it might be harder for it to just become a price war than we're maybe imagining.
Uh, Possibly, but they can just decide to lower the price on what they're offering per. I don't even know what the units are. Like, I'm not an expert on this, but I do know that they could lower the price on per megabyte. I don't even know what how you quantify it, but yeah. All right, you wanted the headline numbers: 16% revenue growth, constant currency, operating margin 32%, expanded from 28% in the same quarter a year ago. $28.5 billion in consolidated operating income. I will say, I think my prediction about Alphabet surpassing Apple's operating income is going to come true faster than I even thought. And I was very bullish on that. Other stuff, employees slightly down. So we're seeing good moderation there of not just exploiting that employee count, which they had a big concern with in 2022. Other stuff, keep buying back a lot of stock, paying out the dividend. Everything looks great. There was one big thing that could hold him up, Ryan, and I'm sure you didn't see this, but a Russian court has fined Google, and you're gonna like this number, $2.5 decillion. That's the real number they fined them. That's about 6, maybe 8 commas. I'm not sure. There's a lot of zeros, and it's because they won't put Russian state TV on YouTube. Is this gonna kill the
So,
business?
so does Google operate in Russia? I assume not.
Don't know after the war of Ukraine started, but I'm pretty sure YouTube probably still starts there. But I'm saying just on YouTube in general, like not just in Russia.
So are they
Once Russia
going?
takes
Yeah.
over Silicon Valley, then they'll force them to pay this fine, which is higher than global GDP, probably cumulative global economic output ever. But they'll pay it back.
Yeah, that is hilarious. I did not see that. So, uh, yeah, I guess people are not factoring that into their models, which
Yeah,
concerning from the investment banks.
but yeah, that's besides the point. I guess anything else on this? Are they officially not losing in AI? Can we say that?
So, yeah, yeah, I think that's safe to say. The other thing that just touching back on the cloud business, you could and you could always like lower your prices on something, but the chances that that takes away from competitors is probably pretty low. Like if Google Cloud reduces the price on something and you have already built your systems to run on AWS or whatever, it's not worth the cost of switching, even if it's a little lower. Maybe on like one of your biggest input costs or something like that, it's possible that you try to look for alternatives. But when something's running smoothly, cloud is usually like I feel like it's just such a pain to switch. Most companies won't want to do it.
Yeah, it's a fair point. I can understand that logic. It, I guess I don't have huge conviction on it just because I'm not no expert on the cloud. So I kind of go, all right, cherry on top. I can understand Google's search, I think, a lot better, but the cloud performance has been. I don't think anyone a couple years ago would have modeled this out. Anything else on Alphabet, Ryan? They gave some for anyone that's interested in not just the financials, they gave a lot of good stuff on the conference call about what they're doing to improve AI tools within search and all their stuff. And they gave a lot of good data points this time. I thought it was fascinating to read. So anyone go check them out. You can find those on FinChat, I should say. That's probably where you should go. One of our nice sponsors. But next earnings, Ryan, what do you want to do? Maybe we'll do. I got a list here. I'm gonna read it off, and you just tell me which one, because then we can alternate to some of yours. Visa, Electronic Arts, Chipotle, McDonald's, SoFi, PayPal, Tesla, or AMD. I try to look at all those at least briefly before hopping on today.
Honestly, I read a lot of those reports and found that well, I guess Tesla was somewhat exciting, but found a lot of them boring. Do we want to talk about Tesla? I will say our predictions were wrong, so we should,
What was the
give
prediction on?
revenue slowdown.
Oh yeah, they
Actually,
actually yeah
gross profit
yeah
slowdown. Sorry, we expected, which may have been a little inflated, and it's hard to say what the how much of the credits they're going to be able to use on going forward. But um, yeah, gross profit sequentially did improve, like big gross profit jump on the automotive business, which I was expecting to deteriorate given some of the price decreases that we saw.
yeah, and operating, and it flowed through down to operating margin. Yeah, good quarter. You know, people say that if we're bearish on something, like, look, we try to look at it as it is. We're not trying to start any sort of war with anyone or any sort of investment group. I do. My least favorite thing about the podcast is when people take any sort of bearish opinion personally. It's not good. We probably, what was it? Probably 5 or 6 bad quarters in a row before this. And this was probably, unexpectedly a good one. Given it's Tesla, the stock jumped probably what, 100, $150 billion in market cap, which, as always, an overreaction. But yeah, good quarter. And it seems like they're doing much better than the broad EV narrative would have said. the slowdown in that sector might be over.
Yeah, that'd be good. BYD, I think, had some figures that came out this morning that were pretty solid as well. So maybe there's some, yeah, maybe there is a bit of a revival there. It, I will say the regulatory credits boosted margins a little more than the ongoing business should produce. So uh, just kind of a caveat there, worth keeping that in mind. But yeah, pretty solid quarter. Have you? When's the last time you actually listened to a Tesla conference call?
Oh, I can't do that. It's a lot of ramblings from from Elon, and then a bunch of accounting people that seem like they're 30.
Yeah, I mean, what blew my mind is like he apparently on the call he said self-driving again, which this is hilarious. Self like robo taxis will be here next year. H- how many times does that need to be said before like people stop believing it?
Yeah, what are they gonna do? Go to Mars first or go to robotaxis? Because they've been both of those accomplishments have been on the couple-year time horizon for the last 15 years. No, not 15, maybe 10 years. But still, like, eventually, you are the boy who cried wolf, and with those 2 things, the company is. Now, it doesn't take away from the fact that they sell, what is it, almost 500,000 vehicles a year a quarter now? That doesn't take away from that, but you have to look at it as it is, and it's not happening yet. And speaking of, we forgot about this, Ryan, self-driving competitor, Waymo, the Alphabet subsidiary, just announced that they are in miles each week. They just raised $5.6 billion, and now they want to use Google's Gemini AI to train its robo taxis. Seems like they're hitting the beginning of the S curve, and they could have a multi-year just absurd growth if they start launching in more and more cities across the US. And that's the real
Yeah,
I mean, that's the operational robotaxis today.
it's yeah. The year's going to be 2040. Waymo is going to be in every city, and operational, and Tesla's going to be saying next year robo taxis will be live, and people will be like, Tesla's leading the full self-driving initiative. Now, it's
Yeah.
first of all, I do find it funny that like you have this subsidiary that's literally gobs of cash on the balance sheet, and you're raising money from third parties.
Yeah, hey, I guess if they
What's
don't
I don't get
if
that.
they want to, maybe the VCs give them an attractive price. I could see a lot of VCs really wanting to get in on the Waymo train, and maybe they get an attractive price, and Alphabet can take advantage of that. But yeah, I don't understand either where they don't just want to fully own it, and then eventually, maybe if you hit some sort of growth runway, spin it out as its own publicly traded company and give it a bunch of cash. But hey, that's not a hard. Their balance sheet it's really not hard to run. You generate so much cash, you have to figure out what to do with it. Um, all right,
But
yeah, Tesla's quarter good. Right,
isn't that
go
a
ahead.
little like as a shareholder, doesn't that upset you a bit? Within the other bets is Waymo, and you'd think like I own shares in Waymo, but and they have the cash to invest in it themselves. They're giving out portions of it to VCs. Like I don't know, that kind of irks me. Like
That is fair. That is fair. I don't know the exact cap table. Sorry, I hate when people use that term, but that is true. Seems like a cliched term. All right, other earnings. Chipotle's was interesting. We talk about that a lot, but
eh,
it is fine.
I don't know.
It is fine. What about SoFi? It seemed like nothing was surprising.
No, nothing really stood out. Comp sales are kind of deteriorating a little bit at McDonald's, which but not bad, like it was expected, which
And that's not surprising.
no, I guess it's kind of interesting to see the quick service restaurants that are holding up in this environment. Starbucks and McDonald's have really struggled. I mean, Starbucks might have problems that are outside of the macro environment, but comp sales have turned negative there. Chipotle's been pretty resilient, 6% plus comp sales growth this quarter. So pretty strong. I believe it was 6%.
People love the slop. They love eating that stuff.
You know what's interesting? Wingstop, 21% comp sales growth this quarter. Stock dropped by
Really?
15%.
Well, that's because it was trading at, I think, 100 times earnings. Expectations matter.
Forward.
That's a good
Yeah.
lesson there. Yeah. What about
While we're on
PayPal? I thought
this,
that was sorry, go ahead.
While
Go
we're
ahead.
on this, I did a little thread this week. I just screened for basically the fastest growing restaurant chains in America over the last 3 years. I'm gonna name all 5. You tell me if you're interested at all. I wanna make sure I get them right, but, I believe it was Cava number 1, Sweetgreen number 2, number 3 was Wingstop, I believe. Number 4, I'm blanking on number
Texas
4, but
Roadhouse.
number 5 was there's one more. Texas Roadhouse might have been number 5.
All right, you
Um,
tell me. I remember reading it and looking at Texas Roadhouse. I mean, all these companies except Sweetgreen. I just don't necessarily understand the concept. And I know some of their top line numbers look good, but doesn't really make sense to me. All these Texas Roadhouse, good model. Cava, good model. Wingstop, good model. But the stocks are all very expensive. Well, I don't know about Texas Roadhouse, but at least Cava and Wingstop stocks are wildly expensive.
Shake Shack was number 4. So those are the 5 fastest growing restaurants in America at the moment, at least on
Shake.
a percentage basis. Looks like it's cutting out a bit.
All right. Yeah, it gave me a little update, but it says it's back. It says we're good. Live recording's still good. All right.
Okay.
Well, yeah. I'll say this Shake Shack. I'm not interested in something that's just burgers. It's too tough to plan. Kava makes a lot of sense to me because there is that differentiation in no one else does this. I know someone can repeat it, but they are the first ones doing this Mediterranean at scale, similar to a Chipotle, although other Chipotle competitors have popped up. Texas Roadhouse, not an expert on them, but they seem to be run well. Wingstop, I'm not sure. They seem to be run well again, but there's a lot of competitors. Restaurants are tough, and you just can't buy at inflated multiples. You just can't.
And
It's
it's
just
so
not
easy
going to
for them
work.
to get inflated. Yeah. It seems like you have a couple quarters in a row of really strong comps and you people extrapolate pretty quickly. And it's so often they can trade at just steep multiples, it seems like, especially if it's a growing concept. Um, if they're adding tons of units, it seems like it tends to get a premium multiple. Do we want to look at my the company on my Moatwatch?
Yes. How the last earnings I want to talk about those PayPal briefly. Then we can move to those. I got a
Okay.
chart to share with you. I would say this was a surprisingly strong report, at least from my eyes. Not sure what the valuation's looking like, but if you see this chart here, and I know take rate has come down, but payment volume across the core legacy business actually grew at 6% this quarter, which has the higher margin. Total payment volume since 2012 has grown at a 22.6% compound annual growth rate to the last 12 months. This does not follow the narrative of the stock price whatsoever. If we look at maybe the take rate, yes, it's come down, but it hasn't come down in a way that destroys the business. And some of it is from that Braintree volumes, which are, I think, more stable. If we look at active accounts, oops, let me click that button. Active accounts have stabilized and started to grow again as they've tried to get healthier accounts on there and transactions per active account have grown. Let me try to look at the cash flow statement here quick. I saw free cash flow, I think over $1 billion in the quarter. Yep, here we go. Oh, there we go. Last 12 months free cash flow, and perhaps given the lending side of things, it's a little bit wonky. $7 billion. And I'm not sure that's the number you want to look at. Maybe we can look at operating income as well, but strong. I thought good and much better than I thought. I really was concerned that this business was going to deteriorate.
Yeah, I'm sorry, Brett, but the internet is just rough right now. Can you hear me okay?
Can you hear me? I can
I
hear
can
you.
hear you now. Okay. It's not coming through. You're not coming through for me, but I guess let's just keep going. Maybe we can cut this out for the podcast episode. Sorry for anyone watching on YouTube. I thought it was a good quarter. PayPal, it looked strong. The take rate came down a little more, but Braintree is growing just faster than the rest of the business. So, that is a lower take, and that's called their unbranded checkout. So it's like you said, it's not killing the business, but it is, I guess, revenues are not going to grow as quickly as total payment volume. They seem to be better capital allocators now than they have been in the past. I think this is one of those businesses where hopefully it'll just kind of grow with digital spending. And if that's the case, you probably get a pretty good outcome from here. So, certainly, yeah, thought it was a decent quarter, and investors seem to have just completely soured on it. So, with that said, do we want to move to Moatwatch?
Yes, we can. Yes, we can. We have a question in the comments, though, that says thoughts on Transmedics. We don't. They dropped 40%. I've seen people talk about it. I don't think Ryan knows anything about the business. I don't either. I should say thank you for the people that are joining us live. And just on a warning on Ryan's Wi-Fi, it's a temporary situation. He's in the transition of a move, so this won't be a permanent setup. And we'll try to get the internet connection stronger. Yeah, we don't want this. We want this to be a high quality recording as possible. All right, yeah, let's do this Moatwatch. I think it's an exciting segment because, hey, that's one of the most important things we want to look for is an expanding or determining whether the moat is getting wider or it's shrinking, and that can be a big indicator of whether it's something you want to add to your portfolio.
Yeah, so the company I'm officially putting on our Moatwatch, or our emerging Moatwatch, I should say, is Reddit, which might have people's like shuddering or concerned. Maybe you just got the chills because of all the meme stock craziness that's happened on there. But the network effect is pretty obvious with Reddit, right? The more people contributing to the platform, the more it attracts other users. And if you've searched anything on Google over the last probably 12 months, you may have noticed that Reddit seems to be showing up way more in search results. Turns out that is not just gut feel. In late 2022, Google changed part of its ranking algorithm and essentially started prioritizing forums more. That helped Reddit in a huge way. And as of the latest report from some third-party data provider, Reddit was ranked number 5 highest visibility domain in Google's US organic search results. Same time a year ago, it was ranked number 68. So it's made this massive step up because of the prioritization of forums. This has also led to tons of traffic to Reddit and ultimately higher daily active users. So daily active users at Reddit, Brett, maybe you can pull up the graphic here from FinChat. It was basically flat from 2021 through to 2023. It went from like 55 million DAUs to 60 million. There was pretty much no growth. Over the last 5 quarters, it's gone from 60 million DAUs to 97 million. So it's absolutely just exploded in terms of active users. And part of me thinks, well, okay, it's totally dependent on Google, which is true to a degree for its growth. But if you are a daily active user on Reddit, it's probably not coming through just search results over and over. You have probably made an account. You're a part of certain subreddits, you're contributing on a regular basis, you're going there directly. So I think it's really kind of helped power Google's prioritization here, or change in algorithm, has really helped power the network effect for Reddit. I will be I'm kind of keeping a closer eye on here because, to on one hand, yes, if there's any change to the algorithm from here on out, maybe it affects growth, but they've 100 million people visiting the site on a daily basis, and it's not Roblox type DAUs where they're double counting. It's active, unique accounts. Um,
And
it
they're not on my
that's
they're not 13 years old, so these
Yeah,
people have uh, well, maybe some.
yeah, it's a real network effect at this point. So, um, yeah, watching them, I honestly don't know how profitable they are, or how they're like, whether or not their monetization is really that effective. But yeah, 97 million daily active users gives you a lot of flexibility to earn money. So keeping them on the radar. Do you have any interest in them, Brett?
I do. Yeah, I would. I'm guessing the valuation is probably absurd, but that doesn't mean you shouldn't research something and put it on your watch list. I'm confident that this website, maybe I would have some confidence that it's around, 10, 15 years from now. It's not something like Pinterest where I get a little bit concerned on the durability. I definitely see the permanent need for forums and people like that. And the fact that you have to contribute so much it means that it is something that someone else can't replicate. You can't just ingest a bunch of AI TikTok videos and you know, then the algorithm does its thing. You need people to contribute, and you can't just have computers generating it. Or who knows? Maybe a lot of the accounts are fake. I guess I'm not sure. But the one concern I would have, like I have with or have had with every other social platform except for Meta and its properties, is the ability to have a strong advertising platform. Pinterest, not very good at advertising. Snapchat, not very good at advertising. Twitter or X, not very good at advertising. Reddit, I would think, is going to have the same trouble as Twitter because it's much harder to monetize text versus vi- visual stuff like YouTube or Instagram.
Yeah. Yeah. There's certainly a possibility. The other thing, this gives me so much belief in Google's moat. The fact that they can just like dictate outcomes like this with the change of an algorithm so slightly. Um,
Oh yeah, yeah. Read the conference call for Alphabet. I will say that again, and you can see the data advantage they have across basically the aggregation of demand. They just had their seventh platform hit 2 billion users, Google Maps, and the advantage they have in AI, which all of that stuff is going to connect together. And if the AI bull thesis is correct, Alphabet has the right to win. And I explained that pretty thoroughly on the call. But hey, maybe Reddit will
right.
benefit because
Yeah. Possible. All right. Before we move on, we want to talk about our friends at Public. Listen up, folks. Time could be running out to lock in a 6% or higher yield at public.com, but you can lock in a 6% or higher yield with a bond account. Your yield is not locked in, however, until the time of purchase. So you might want to act fast. Lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds only at public.com/Chit Chat Stocks. That is our lovely sponsor, Public. Again, I will say, made an account myself. It is very seamless, very easy process. Does not take very long, and was significantly easier than a lot of the legacy brokers. With that said, I do want to talk about DR Horton and the potential housing downturn, which you may have called, Brett. You may have gotten it right.
hey, hey, I would say get the existing home sales is maybe one thing. Existing home sales and inventory. If I learned anything from following the housing analyst, track those charts, track that data, because that can have a big impact on demand for the home builders.
Okay, let's look. So I say housing downturn overall, but really it was just DR Horton's earnings report. So DR Horton is the largest home builder in America by volume. They reported earnings this week, and the stock dropped, ironically, because we talked about this in a recent episode. What stocks would we buy on a 20% drop? It almost dropped 20% right after earnings. So, actually did not end up buying. But, anyways, there was some interesting commentary on the conference call. Uh, DR Horton's CEO said, while mortgage rates have decreased from their highs earlier this year, many potential home buyers expect rates to be lower in 2025, which is kind of like delaying demand. And then someone asked about this, like, is this common? Kind of what are you seeing? Or if rates went up again, would they feel more inclined to buy? That kind of thing. He said, more than any one given rate, I think stability in rates is most helpful for us in seeing buyer demand and come off the sidelines. So that they're not waiting for rates to come down or fearful that they're going to go up. They're just going to escape affordability. They're going to escape their ability to afford right now. Basically, I don't know if they're trying to just kind of point fingers at issues or really figure it out. And it seems like they see a little bit of a rate decrease and they're looking at, oh, maybe this will continue into 2025, whatever, which makes sense, I guess, if that's what you believe and you're holding out to buy a home. I wonder, DR Horton's the biggest home builder in America, but I'm curious what happens to other home builders as well. A lot of home builder stocks sold off on this news. DR Horton said that they're probably going to start to offer larger incentives like mortgage buy downs, which basically just reduce the rate for the first couple of years kind of thing. It doesn't affect the average selling price, but it
That
will
which
hurt.
impacts margins. Yeah.
Yeah, it's going to hurt gross margins for DR Horton. Um, they also emphasize that throughout the call that they're pushing more towards build to rent units as well as like redesigning some floor plans within their land plots to make them smaller homes, smaller units, which helps affordability, might hurt the gross margins on a per unit basis, but if you're able to build them out effectively over a huge plot of land, it's a bunch of smaller units, you can still achieve the same margins in aggregate. It kind of interesting. Moving towards build to rent, and then they also said they're moving a little more towards townhomes. So the stock was down as much as 15% after earnings. For the companies that don't have as much flexibility to be able to pivot like that, I wonder if this means potentially we see some real cash flow constraints, some problems for some of the home builders.
Definitely could. Yeah. It's a very hard market to understand. It's one that's when, the Fed can determine your fate for a year or two, and seeing the mortgage rates jump back up to 7%, yeah, it's a bit concerning. And you're seeing the freezing of the market, which helped DR Horton because the existing homes were stuck. People weren't leaving them. So we needed new homes to come online. But if that switches, or if it's so frozen that no one wants to buy new homes anymore, yeah, it's going to hurt you. It's going to hurt you. It still seems like a good business, and it's one that'll do well over the long term, but it's hard to tell. And maybe something we didn't focus on enough in that episode that we posted last week is the margins and whether affordability or not affordability, but supply versus demand dynamics can impact that, even if DR Horton has the most scale.
Yeah, well, a lot of people saw this and were like, supply, there isn't a supply shortage. See, and that doesn't, I don't know if that's really
It's
the
just one
case.
quarter. It's one quarter.
Yeah, let's put some brakes on any, I guess, big guesses in terms of what happens with homes from here. They're still forecasting home closings growth next year. So uh, basically flat to up like 1 or 2 percentage points. And that's, 90,000 plus homes delivered in a year. So pretty good. Or pretty large, I should say. I guess, I don't know. We can go round and round in circles with DR Horton. It's not quite that fun. But do we want to talk about any other stocks, any other big earnings before I get to my small cap of the week?
Yeah, let's maybe do small cap of the week first. Why don't you talk about make sure to update our friend listeners about our friends from FinChat and do your small cap of the week sponsored by Yellow Brick. And then if we have time, we'll cover as many earnings as we can as we end this episode.
All right. Yep. Small cap of the week. This is presented by Yellow Brick Investing. The reason I say it's presented by is because every time, and this is exactly what happened this time, someone sends in a recommendation. Thank you to, I'm not sure who actually sent this one in. Brett, you relayed it to me, but Simulation Plus, it's mostly a software, but also a services company. Um, First thing I do, never heard of the company. I go ahead, type in the ticker or the name to Yellow Brick's directory, and you instantly find some high quality write ups, which is exactly what happened here. So, Simulation Plus, I guess I can just go through maybe some quotes from the write ups that I saw. It says, from a business perspective, the company sells biosimulation vertical software to pharma and the FDA. They are part of the regulatory process, and services are added on top to ensure pharma clients go through the compliance process smoothly. As a reminder, the FDA uses the product during application reviews. There's a big upsell cycle currently underway, and pricing power has been coiled. This will all start to inflect in the coming years under new reporting. This is someone who's quite optimistic about it. But, and I will say revenue growth has looked really strong, 16% CAGR since, that's compound annual growth rate since 2015. However, there's been some acquisitions in there, actually quite a few acquisitions. So it's a bit inflated, and organic growth does not look quite the same. There was, however, a short report that I found as well, which maybe tempered my expectations for the business. And keep in mind, some of this is outdated. Simulation Plus a couple of years ago traded at really a ludicrous multiple, and the stock is down more than 60% since this write up. So kudos to the guy that wrote this, or person that wrote this. Says, far from a hot startup, Simulation Plus is actually a fairly mature 25-year-old company with the majority of its growth coming from a lower margin consulting business and acquisitions. Simulation Plus sells licensed software for pharmaceutical research and development, and its core product, Gastro Plus, simulates the mechanics and interactions of drug compounds. He says, while GastroPlus is by all measures a quality leading product, its addressable market is fairly limited, with revenues growing to just around $20 million since its launch in the mid 90s. I think that's a good point, actually. Like this, if this is a leading product and it's been around for 25 years, only generating $20 million in revenue from it, it might be able to grow. You might be able to raise prices, that kind of thing, but there might be some limitations in terms of customers. I'm not really sure what to think here. Earnings per share has only grown in the high single digits relative to revenue, which has grown at 16%. So, and keep in mind, there has been some margin deterioration as of late, which makes it look worse than probably would be. But $615 million market cap, $6 million in operating income over the last 12 months. Like I said, there was apparently a one-time cost that is hurting profitability over the last 12 months. So I'll give them the benefit of the doubt here, and I haven't done enough research to really make it form, I guess, a valid opinion. But if I use their peak earnings from 2022, which was about $15 million in 2022 operating income, it'd be trading at 41 times operating income for a business that's growing, I guess, maybe high single digits, low double digits for like organically. I just don't really love the setup here. So probably going to end up passing, but I do really appreciate the recommendations from audience members on potential small caps.
Yeah, it does seem a little expensive. I was checking gross profit too, even if the peak gross profit, as you mentioned, I'm just going off of August 2023 is 48 million. That's not dirt cheap. I mean, hey, if you think that like that, a lot of that can convert to operating income over time, sure, that could be cheap, but I don't think that's dirt cheap. And it's not an industry that I think I have any sort of skill in. And what was it, an upsell or an inflection coming? Like I don't have any skill in predicting that or understanding whether that could be the case. But yeah, Ryan, and do we want to highlight our sponsor of this segment, Yellow Brick Investing, and tell people where they can find that?
Yeah. Yellow Brick Investing, they are the wonderful aggregator of the best stock pitches across the internet. So fund letters, Twitter, blogs, newsletters, Substacks, podcasts, even a couple of our uh, pitches have been on there. They collect and summarize the best stock pitches and bring them to you in a single place. So check out joinyellowbrick.com/chitchat and you'll get a discount as well. It is free, but if you want to upgrade to any paid plans, you can use that code for some discounts. Try it for yourself. Highly recommend.
Yep, and
Now,
our other
Brett,
sponsor is or sorry, let me talk about our other sponsor, finchat.io. You can get a 15% discount on any paid plan by using our link in the show notes. We appreciate all the people that use it, and it is a vital research tool during earnings seasons, transcripts, reports, data, financials, KPIs, updated in a timely manner. And I use them every day during earnings season, researching stuff for the show and for my own portfolio. So the link's in the show notes, finchat.io/chitchat.
now, do we want to talk about your favorite company, Supermicrocomputer?
Super. Yeah, let me give you a quote here, Ryan. This is the quote from Ernst& Young, SMCI's auditor. Quote, "We are resigning due to information that has recently come to our attention, which has led us to no longer be able to rely on management and the audit committee's representations and to be unwilling to be associated with the financial statements prepared by management. And after concluding, we can no longer provide the audit services in accordance with applicable law or professional obligations." That says guilty right there. I mean, they are saying, you are guilty. It's over. Stock is down 32% today. Year to date, did you know the stock is still up 17%? Uh, but it was at one point almost at $120, and now it's at 33. This was an AI bubble stock. It doesn't mean that Nvidia is a bubble. That's another discussion. But this is what happens when there's a boom. Some of these shenanigan companies pop up, and whew, wow, that is one of the most damning things I've ever seen from an auditor. They straight up just said, "We found we can't trust these people anymore." And given how much the audit firms have given leeway to these companies in the past, and saying, "No, no, no, it's fine. Like, it might be a little sketchy." Like this is, it's not like they're strict. Usually, they'll audit any company. This was bad. I
Yeah,
stock. I'd say like yeah, I'm surprised it's not down more. But yeah, you go ahead.
no, I mean, we're talking about an S&P 500 company that, like, that's a huge revenue generator probably for, I mean, Ernst& and Young, obviously a large company, but for them to turn down a big chunk of revenue tells you what they think of the financial statements here. Yeah, that's probably one of the most damning quotes I've read. Even you look at like short reports and stuff like that. That was a very damning quote, especially when it's coming from an auditor. So yeah, it's literally saying we are rejecting your money because we think we can't work with it. It's lies, essentially. Shout out to I guess the S&P 500 committee for including them and making it a part of people's retirements, getting none of the upside and all of the downside.
Yeah, it's yeah, there's just a little bit of index fund money in yeah, tracking the S&P 500, right? It's not that much. It's not everyone's retirement that they're building up over many, many decades. No, but yeah, this is the unfortunate thing that happens nowadays. Happened with Tesla too, right when they were peaking. Yeah, you can get it can happen. But hey, Google makes up for everything, right?
Yeah, I mean, I guess this is probably an inconsequential amount of the index.
Exactly, exactly. All right, what else do we want to talk about? I mean, there's not really anything else to talk about. Super microcomputer, it's done. It's like it's over. It could be a WorldCom.
It's
I
so.
think WorldCom makes a lot of sense here. I think that's
Who was it that wrote the short report? Was this Hindenburg?
Hindenburg. Yeah. If you read again, I know the short reports are long, but that was the one I did decide to read, and I don't fault anyone for not reading it because they do take time. It was pretty clear there was so much smoke. Like it was it was blinding. It's like a California wildfire.
Yeah. Hindenburg, tell you what, Hindenburg, and they deserve a lot of credit. And I will say, if they write a report on a company you own, you may want to read that thoroughly because
Yeah.
it seems rare that they miss.
Yes, sir. Yes, sir. All right, what else do we want to talk about? Dropbox, maybe? Cut 20% of its workforce. Our favorite stable coin. Stock doesn't go anywhere. Mm, that's pretty
Yeah.
much the entire news item there. GDP
Well,
growth
there
was
was,
good.
yeah,
That
well,
that's
GDP, great.
something.
I guess the Dropbox, I will say, I'm glad to no longer be a shareholder there. It's just tough. It's a very competitive business. If you read the letter from Drew Houston, I will say he does better than maybe some of the other uh, CEOs at sending layoff letters because he literally says this is my decision. It's I take full responsibility for, and I'm sorry essentially to anyone being affected. However, it's pretty concerning from a shareholder standpoint because in there it also says demand has really weakened and we can no longer support this. And I don't know if that's just an excuse for employees or it's legit and they can no longer support 20% of their workforce, which, if that is the case, I'm not sure Dropbox should be trading up on this news. It's up like 4%.
Yeah. Yeah. I mean, they've already optimized a lot. It's hard to tell. We'll see what happens with their earnings reports. The earnings reports are always like if the narrative on Dropbox is good, they always disappoint. But if the narrative is bad, that's why I call them the stable coin. The narrative is bad, they always do a little bit better than people are expecting. It's kind of like, all right, decent revenue growth. Is free cash flow per share really growing that much? Yeah, a little bit, but it's nothing explosive. And uh, it's an interesting one for sure. The way they're doing the capital allocation and stuff like that. What did you think? Did you see Visa's report?
Blah, boring. So boring, honestly. Like payment volume grew mid to high single digits. Shocking. It's just so
Yeah.
it
A little bit of an
it
acceleration, though.
yeah, it just never looks that attractive to me. Like it is so mature. It touches
That's
so
fair.
much of the economy already. Like so many transactions. I just it's hard for me to get really. It will grow probably forever as long as regulators let it, but I just have a hard time getting excited about the stock.
Yeah, I agree, P of 30, but hey, diluted earnings per share grew, and this was in Q4, 17%. If you look at guidance for 2025, they give funny guidance, so I wanna read it. Revenue growth for full year 2025. Now let me see if you can figure out what this number is. High single digit to low double digit, so 10%. Operating expense growth, same thing. But this is my favorite. Diluted earnings per share growth. They are expecting the high end of low double digit. What do you think that
What,
is?
what does that mean?
High end of low
13%?
double digit. Yeah,
But
that's
couldn't
exactly
that
what
be
came to mind.
51%?
Yeah, it's true. There's a lot of double digits out there. I think 12% makes sense. But e- regardless of that joke, 17% growth, 12% growth this year. I don't fault people for holding in at 30 times earnings, but yeah, it doesn't seem
It's going to be
that
hard to,
cheap.
yeah. Will you beat the index with that?
Hey, it's trading at basically the S&P multiple, so maybe, maybe. I think, I doubt the S&P will grow earnings as fast as Visa.
It's a fair point.
But look, I
Yeah.
don't think the S&P is going to do well, inflation adjusted over the next 10 years. So yeah. Um, Anything else? Oh, we had a question here. I think maybe we can close with some philosophy type stuff, investing philosophy. This is a good one. So It's a little bit long, but I'll read it. If Charlie's quote below is accurate, then why am I waiting for Visa, MasterCard, blah, 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 Costco to get cheaper before buying them? Quote, if a business earns 18% on its capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. Or to put the question the other way, what do you do when a stock you've started a position in starts to run away? I got 3% in Google in the low 150s, but now what am I supposed to do with what is probably going to open at 180 tomorrow? I'd say don't get too specifically on Google. Do not get too particular or cute about it when it's just jumped that much. I think what Munker is talking about and how we like to look at it is if things get really extreme, like if Google went to 40 times earnings. Given the earnings growth, I don't think low 50s versus 180 is even that different from an earnings ratio perspective. But given that quote, what Munger is talking about, I don't know if it applies in the 21st century to some of these things are trading. Because if you look at what he has talked about with Costco, one of the premium quality stocks that he's owned, RIP, did own. He said he would not even, there would be no chance he was buying it at 50 times earnings. So his quote, he's going against his own quote because eventually the math works against you. You have to care about price. And yes, you should consider the quality and the growth and all that stuff, but price does matter. Just depends on what you're paying for.
Yeah, I think it's probably been taken out of context because he says, paying too much, it might not be. People might think, oh, okay, that means I can pay, whatever multiple for the high returns. That is not what I meant. Now, if you're debating between 15 times earnings, 20 times earnings for Google, and yeah, frankly, probably over 20 to 30 years, it's not going to affect, probably not going to have a huge effect on your returns. But I think studies have been done that have shown that that quote isn't exactly correct. If there is massive multiple compression, it has a huge impact on returns, even over that 20 to 30 year period. So
Yeah, just do the math.
yeah, it doesn't. Unfortunately, I would say maybe don't act rashly purely because of that quote. Also, it's really quite difficult to know what companies are going to earn 20% returns on capital over 30 years, because
Yeah,
so much can
exactly.
change.
Yeah. But then
All
on the
right.
other hand, what we're talking about there is buying. Now, if you're thinking of selling something, we're of the opinion that you should never, maybe not never, but only in rare circumstances when a valuation gets absolutely crazy, you should only sell if the business is telling you it's deteriorating. And Google's earnings report told you the business is firing on all cylinders. So there's no reason to sell that right now, especially when it hasn't moved that much.
All
All
right.
right.
Should we
I
wrap
think that's
there?
going to do it. Ryan? Yeah. Any closing thoughts, Ryan?
No. Uh, Cheers to earnings season. Happy Halloween to those who celebrate. And hopefully your earnings reports will not be too
To those who
spooky.
celebrate. Yeah. Ryan's targeting our 5 to 15-year-old audience. For the
Yeah,
trick or
which is
treaters.
huge chunk of our
But yeah.
listeners.
Yeah, exactly, exactly. Hey, I bet a lot of our listeners have young kids. We do have that kind of 30 to 40-year-old listener base. But yeah, let me hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan and I may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Nothing we say is a recommendation on this podcast. If you're listening to this, if you listen to the full episode, I should say, give us a review, 5 stars, hopefully on Apple or Spotify. We've seen people do that, and it is the best way to help support the show. Just go on the page, click it. It's very quick, takes about 5 seconds. You can also follow us on Twitter, Substack, wherever. Thank you for supporting the show. We do these live every Wednesday, 1:30 p.m. Eastern Time on the Chit Chat Stocks YouTube page. You can join us then, listen to the replays on YouTube, or listen to the replays wherever you get your podcast on Sunday morning. Thank you, everyone, once again, and we'll see you discussing more earnings next week.